Hello, beautiful people. Welcome to another brand new edition of the ITU Forex class. In this week's episode, we're actually going to be talking about a topic which is which I find very interesting because it's related to risk management. And if you've been a frequent attendee to any of these classes, you'd know that I'm very, very keen on practicing proper risk management because contrary to what a lot of newbie traders believe, you don't need a winning trading strategy, a trading strategy that will give you winning trades like 100% of the time to be able to squeeze profits out of the markets. Okay. When we first started, most of us thought, you had to find that holy grail trading strategy that was the top secret strategy that would give you winning trades 100% of the time. But the truth is, you don't need that. The thing is, you can find a trading strategy that has a win rate that is even maybe between 30 to 40% and still end up being profitable. And someone else could have a trading strategy that gives him winning trades 90% of the time and still not be able to make money or even end up losing money if that person doesn't practice proper risk management. And that's why instead of focusing 100% of your attention and effort or focus on trying to find that winning trading strategy that will give you winning trades 100% of the time, save that energy and just use it to learn proper risk management. Okay, it's going to help you way better, way a lot more. Okay, now the reason why I said today's topic is one that I'm excited about is because, as you probably know now, the topic which we're going to be talking in this week's episode is how to use the ATR indicator to identify stop losses. That's how to use it to place proper stop losses. Okay. Now the thing is, even though I'm very vocal about using proper risk management or practicing proper risk management as you go about your trading, there are ways for you to do it. Let me put it this way. There's the right way of doing it and there's the wrong way of doing it. Okay. You don't just place a trade and just randomly place a stop loss because I said, or some other coach you heard on the internet or physically or whatever the case might be, told you to do proper risk management. Yes, it's good for you. It's a good risk management practice to always place stop losses for the trades you place, but you have to place them optimally. So let me give you an example. Let's assume that you trade with, let's just use a simple example here, a simple trading strategy, nothing complex. Okay, let's say you're using market structure to identify when to buy and when to sell. Okay, so starting from the the furthest place we can see on the chart, price was moving kind of like in the downtrend because it was making lower lows, lower highs. Okay, let me do this. It was making lower lows, lower highs, lower lows, lower highs, lower lows consistently up until the moment when it made this lower high and then it made a lower low, but then eventually price couldn't continue moving to form lower lows and lower highs, and then it went to break above this resistance area, and then now when it formed this move, we now went from forming lower lows and lower highs to now forming higher highs and higher lows. Okay, now when you saw this shift in momentum, when price went from forming lower lows and lower highs to breaking this trend line and now starting to form the market structure of an uptrending market, which is the formation of which is characterized by the formation of higher highs and higher lows, you would want to, if you're a trend trader, obviously, you would want to align yourself with the direction of the trend, which at this particular moment in time was bullish. Okay, because price was forming higher highs and higher lows. Now, in this case, there are lots of ways you can go about it. When we had this resistance here, and then price broke above the resistance and then pulled back, okay, you can see that we had the formation of a bullish engulfing candlestick somewhere around here, even though it didn't fully engulf this particular candlestick, okay, this particular red one. You can see that it's more than halfway there. So assuming you saw this as a retest and then this was a resistance that was broken, and now as price was testing it, it was getting rejected. Assuming you saw this as a trade setup, as a trading opportunity, and you placed a buy trade here, there are lots of ways you can approach placing its stop loss. Okay, if you approach this with the intent of placing a conservative stop loss, when I say a conservative stop loss, what I mean is you're placing a stop loss which is relatively far from the trade entry level you entered into the market with. So in this case, let's assume you entered the market somewhere around here at the close of this bullish candle. Okay, if you were to place a conservative stop loss, that would be placed somewhere below this low. And the reason for this is because this was price switched from forming lower lows and lower highs to then changing its character here and then forming higher highs and higher lows. Now, when price started forming these higher highs and higher lows, excuse me, this was our origin low. And then after this origin low was formed, the next low that we had, which is a higher low, was this one. Now, the reason why I say this is a conservative stop loss to place is because if you were to place your stop loss below this low, this would mean that for whatever reason, if price was to come from all the way here that you entered into this trade and then break below this low to trigger your stop loss, then really this particular market structure, which is characterized by the formation of this bullish market structure, which is characterized by the formation of higher highs and higher lows, would have been invalidated. So this would be the wise thing to do, because now if price was able to break below this particular low from all the way here to break below this low, then we are no longer forming higher highs and higher lows, which will be a valid case for us to say that we are no longer in an uptrend, even if that is just temporary. Okay, so this would be our safe stop, and that's why it's called a conservative stop loss. But just like with any other thing in trading, there are pros and cons to everything you use, or to every approach you use out there. When you are using a conservative stop loss like this, because it is conservative, the pros is that since you are entering at a price, your stop loss is kind of a little bit far from where you are entering into the market with your trading position, your stop loss is going to get hit a lot less. So this would improve your win rate, because you're going to lose a lot less trades. But there's a catch, and that catch is because your stop loss is far from your trade entry relatively, okay? This would mean that if you're trading and using exits based on risk to reward ratios, for example, hard-coded 1:2 or 1:3 risk to reward ratios, this would mean that price would take it would take price a lot of work to hit your profit targets. So, for example, if you're using this conservative stop and you enter this trade from here, this would mean that from this area where you entered into the trade to your stop loss, the conservative stop loss, the distance between this is around 30 something pips. And bear in mind, this is for the Euro USD currency pair. A 30 something pips move for the Euro USD currency pair is actually quite something, because the Euro USD currency pair is not as volatile as other pairs like the GBP JPY or the USD JPY, for example. Okay, and so if you place this trade like this and you are going for a 1:3 risk to reward ratio, price would need to move 90 pips for you to make 3 times what you're risking on the trade. Okay, and so I told you the pros is because your stop loss is far from your entry, your stop loss is going to get hit a lot less, and so your win rate is going to be slightly better than the other person who is going for the aggressive approach. On the con side, because you are using that, wide stop loss, if you're using fixed risk to reward ratios like 1:3 or 1:2 or whatever the case might be, the distance that price would need to travel in order to hit your profit target is also going to be a bit far compared to the person who is using the aggressive method. Now we've talked about the conservative method, right? Let's check an example of the aggressive method. If you are using the aggressive method for stop loss placement, then your stop loss will be placed right below this low. Now, what is, again, like I told you, in trading there are pros and cons to every approach you take. The pros for this particular method is that because your stop loss is not going to be too far from your entry, then you're actually going to get better risk to reward trades. So in this particular case, assuming you placed this trade, your entry was somewhere here and your stop loss was just right here. You see, your distance from your trade entry to your stop loss would be around 15 to 16 pips. Now, if you're aiming for the same number of pips that the person who was using the conservative approach is aiming for, this would mean that you would end up, with a trade that would give you almost a, let's say, almost a 1:2 let's say 1:6 or 1:7 risk to reward ratio trade. So if you were risking 1% and you were aiming for the same profit target that the person who was risking that same 1% but had a conservative stop loss was risking, if price hit his profit target, he would only make 3 times what he was risking because his stop loss is wide. But you would make almost 7 times, let's say 6 times what you are risking because your stop loss is tighter. Now, this is the pros for using the aggressive stop loss approach. But the cons is, because your entry is pretty close to your stop loss, price would more often than not hit your stop losses more often. So your win rate is going to be a lot lower. But on the con side, even though your win rate is lower, because on average your profit is much larger than the other person who was going for, let's say conservative stops with smaller risk, reward to risk ratio trades, you would end up making more profits than him, even if you have a lower win rate than him. You just need to choose what works for you. Okay, so the thing is, you just need to pick and choose which one works for you. Now, with this explanation out of the way, this makes it a optimal place for us to talk about the ATR indicator. Okay, so what exactly is the ATR indicator? The ATR is it's just a short form for average true range. So let me explain what it is for you, because I want, when we do these classes, I don't just want to give you tools and say, okay, this is how to use them. I prefer for you to learn the logic behind those tools so that they would make sense to you. And when you choose to use them, they would actually help your trading, with a way that you're actually using it for what it was designed to be used. You're not just blindly following someone. Okay? So let me quickly explain what it is to you. You see, when we talk about range in trading, we're actually talking about distance moved by price. So for this particular example, okay, let's say you had a candle which opened somewhere around here. Okay, for this particular, because this is a bearish candle, it opened higher than it closed. Okay, it closed somewhere around here. But then during the lifetime of this candle, it went all the way up here, and then it came all the way down here. So the highest high for this particular candle, this is a 1 hour chart, so this was a 1 hour candle. The highest high was around here, and the lowest low was around here. Okay, now the distance between the highest high and the lowest low is what is known as the range. Okay, it's the range. So what this average true range indicator does is it calculates the range of a set number of candles. You're going to set that as a parameter depending on what you want. Okay, so it calculates the number of it calculates the range, the average range for the number of candles you set when you are placing the indicator on your chart. Now, what does that have to do with anything? Well, the indicator tries to gauge the volatility, the level of volatility in the market. So if the range of a candlestick or a couple of candlesticks have been increasing, if their bodies have been increasing over time, their range from the highest, remember, from the highest high to the lowest low of the candle, if they've been increasing, that means there's an increase in volatility in the market. More participants are participating in the market. But if there's a decrease in volume of volatility in the market, you see that the range will be constricting. It will be smaller and smaller and smaller. So with this explanation now out of the way, let's look at an example before we add the indicator on the chart. A couple of examples. Okay. Now you can see this is a price move that we had where price was going down. But before we had this move where price was going down, you can see that we also had a couple of candles here where price was going actually nowhere because we were kind of ranging. Now what I want you to pay close attention to is the fact that when price was making this move, you can see that the range for this candle in particular, for example, was from all the way up here to all the way down here. If we measure it, this is around 21 pips. The candle next to it, how many pips? You can see from all the way up here, that's its highest high, to all the way down here, that's its lowest low. It's around 20 pips. So when we keep measuring these candles, you can see that they have relatively large ranges from their highs to their lows. But then compare it to when the volatility in the market was very low. And so you see that from the high of this price up here to its low is around here, just around 9 pips. The same thing. From the high here to the low here is just around 10, 11 pips. Again, from this high to this high is very little. So you can know that based on this particular movement, you know that there are low participants in the market. There's a low volume of trading that was going on in the market when these candles were being formed. Compared to when these candles were being formed, it's obvious that we have more participants in the market and more volume in the market for what you're trading. Now, the ATR calculates these values and it gives you an average. So how do you use this? There are a couple of ways that traders use this particular indicator. Let me quickly show you how to add it first. To add it, go to the Insert tab and then click on Indicators and then hover your mouse's cursor over Oscillators. You see Average True Range inside MetaTrader. Just click on it to add it. The default settings that most traders use is just 14 periods, meaning it takes the average range of the last 14 candles and it computes it and plots it on your chart in its window. Okay, so we'll just go with the default value. There's no need to change anything here, and we'll just click on OK. Now, notice what happens here. When we add it to the chart, when volume was decreasing, you see that the range between the high of the candle and the low of the candle, it was getting smaller and smaller and smaller and smaller. You see that the indicator was going down, meaning it was showing us that the range for the candles, the average range, was going down. So the volatility is decreasing. And then when the volatility was increasing, when the range between, that's the distance between the highest price and the lowest price, was increasing, when there was a lot of participants in the market, you see that the range of the indicator was actually going up. It was showing us that volatility is increasing in the market. Now, how do traders use this? Some professional traders use this to help them gauge where to place effective stop losses. So, as an example, let's say you are a trader who trades break and retest or divergence or anything like that. So let's say you identified that there was kind of like a resistance here. Price was forming higher highs and higher lows. Remember our market structure? Higher highs, there was a break here and it retested higher lows. So we would expect that price would continue forming these higher highs and higher lows. But then it failed to do that here and it formed this higher low. It came again to try to break above this resistance, but it failed. And then it broke below this higher low. If this was truly a strong uptrend, price would have no business breaking below this, except if it was just a liquidity sweep or whatever. But then, even after it broke this, it failed to break above this resistance area, and it immediately got rejected. Now, the way some traders would use this is when they identify their trade entry level, instead of just randomly placing a stop loss somewhere around here or whatever, they would identify that, okay, this was a resistance that price was finding difficult to break. So some traders, because there are liquidity grabs in the market, so some traders would be like, you know what, I could enter this trade now, and then maybe the institutional traders might want to run my stop loss before pushing price in the direction of the range of the trend. Okay, so what they would do is, instead of just blindly placing their stop loss above this resistance area, they would look at that particular moment in time when they were getting into the market with the trade. They would look for what the reading, what the value for the ATR was. So in this case, somewhere around here, the value of the ATR would have been, let's say, around 15 pips. This is 0.0015, okay? 152. So let's just say 15.2 pips. So instead of placing a stop loss around here, remember, the ATR calculates the average range. So the trader would be like, okay, I would place, instead of placing my stop loss around here, since the average range is around 15 pips now, I will place my stop loss 15 pips above this resistance area. And the reasoning behind it is that if for whatever reason, after I get into the market with my trade around here, and then price is able to not only break above resistance, but even move past that resistance with the number of current value of pips for the average range of this would clearly tell me that price is not about to reverse. It's likely going to continue moving in the direction of the trend. This is one way some traders use it. So instead of just placing their stop loss above resistance, they will place it above resistance with addition of the number of pips that their average true range indicator was reading at that particular moment in time. This is one way traders use it. Another way that traders use it is they will not enter trades until there is a clear increase in the volatility in the market, in the range of the candles within the market. And this makes sense. This use case makes sense. Let me explain to you why I say it makes sense. The reason is because when we enter into a trade in the forex market, it's one of two things that is going to help us to make money from that trade. If it's a long trading position, as we entered into the market with the trade, let's say we enter somewhere around here. If price does not move past our entry, then we're not going to make any profits. In fact, if price was to move from our entry to where our stop loss is, we would end up losing money. So however you look at it, we want, after we enter into the market with the trade, we want price to move. Either to move in favor of our trade to hit our profit target, or to move against it so that we just, hit our stop loss, which we've already predefined, and just call it a day and look for the next trade setup. Now, if we were to enter a trade, but then there was no volume in the market to either push price to go above to hit our profit target, or to go below to hit our stop loss so that we take another trade setup, we could be stuck in that trade for almost eternity if price doesn't go anywhere. So as a trader, we want volatility, because volatility will help us to take trades, and then those trades will move. The volatility will cause price to move to either hit our stop loss or our profit target, so that we'll continue trading and make money, or either lose money in a controlled way with proper risk management. So this way that traders use it, which is what I'm explaining to you now, is they would add a certain threshold on the indicator's window. And so if the indicator does not cross above that particular threshold, they will not look for any trade setups, because that is showing them that there's very low volatility in the market. So the only time that they are going to want to take trades is when they clearly see volatility increasing in the market, and that the ATR will show them that by going from down to up. So let me show you an example. Let's assume that a trader, let's just use myself as an example, and I'm using the second method. When I'm adding the ATR indicator to the chart, I'm going to add a level. You can see currently there are no levels at all. So let's say I want to use it to identify when there's volatility in the market, so that I can take trades in the direction, regardless, in the direction of the move, so that the trade will hit my profit target or stop loss. Now I'm just going to add a level. Some traders like to use, depending on the currency pair that they're trading, a value of, let's say, 20 or whatever the case might be. If I'm not mistaken, let me see. Let me add 20 here. Yes, that's not going to work here. So that's not 20. It should be 0. It should be written as 0.020. Yes, this is 20 pips, because that's how it reads here. Okay, so you can see this is what it's going to look like. Okay. Yeah, I see where the issue was. So I was adding it around 20 pips, and you can see obviously that 0.20 is not even here. The highest is 0.16. So for this particular example, I just added it to the 0.10 value. So 0.0010 value. So this is like 10 pips. Okay. So some traders might use this in a way that whenever the ATR indicator is below these dotted lines, for you to see it clearer, let me just quickly turn the line to the color black and leave it like this. You can see this dotted line, okay? So a trader might decide that whenever the ATR value is below this dotted line and it is sloping down, he's not going to take any trade, because this is showing him that volatility in the market is decreasing. And you don't want to take a trade in the market when volatility is decreasing, because that would mean that, price is not moving all that much. So it's going to be a little bit difficult for it to hit your profit target or your stop loss. But let's assume that you use this in such a way that you are only going to take trades when price stops going from down and it starts heading up and even closing above the dotted line here. So in this case, what would this correspond to on the charts here? You can see that based on market structure, and this is where trading with a confluence of, a confluence of things will help you to decide when to buy and when to sell. So let's assume you're trading based on market structure. Again, price was making higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. But then eventually when it reached here, it failed to continue making that higher high and higher low. And now price went to, even break below this higher low. and now it's forming the market structure of a downtrending market, which is the formation of lower lows, lower highs, lower lows, lower highs, lower lows, and lower highs. Okay. Now I'm just going to move forward to where we saw this setup, for example. So you can see that in and around here, the ATR was going down, it was sloping down, and we don't want to take trades when the ATR is sloping down. Rather, we want to take trades when the ATR is sloping up, because that is showing us that there's volatility in the market. Now, when the ATR was sloping down somewhere around here, we were not interested in any trade. But then you can see that the volatility started to increase slightly. We've already established that we are in a downtrending market, because that is what market structure is showing us. Now, let's assume that when you saw this candle, let me do this. When you saw the formation of this price rejection candlestick, the ATR closed above here, and you saw the formation of another price rejection candlestick, this would have been a proper sell trade setup for you. So you would have easily taken a short trade setup somewhere around here, either at the close of this candle, or at the close of this candle, or any one of them. If you were using the aggressive approach, your stop loss would be immediately above this. But if you wanted to use the conservative approach, you would place your stop loss not only above this area, but the reading for the ATR at this particular time was around 10 pips. So your stop loss would be placed above this, 10 pips above this resistance, because this would have been, you placing your stop loss not only above resistance, but above resistance with the number of pips that is the average of the true range of the candles on the chart at that particular moment in time. And if you did this, your stop loss would, let's say somewhere, it would be placed somewhere around here. And so if you're going for a 1:2 or 1:3 risk to reward ratio trade, this would have easily hit your profit target. The thing that I want you to understand is that just because somebody tells you to do proper risk management, that does not mean that when you identify a trade setup, let's say you wanted to go short here, because you're just told to place a stop loss, you just place maybe a stop loss just above here. Because when you do it, when you don't place stop losses properly, price would frequently take you out of good trading positions, only for you to sit and watch price to move in the direction of that particular trading position. So for this particular example trade setup, let's go down to the 15 minutes time frame to illustrate exactly what I'm trying to point out to you. So let's assume that you wanted to take this trade setup just like I showed you here. Okay? And then let's say on the 15 minutes time frame, you identified this setup when you were somewhere around here. Okay? So price broke above this, it retested, and then when price formed this, you decided, yay, price is going down, we have the market structure of a downtrending market and all of that. And so when you saw this pin bar candlestick and this hanging man, you decided, yes, this is a good time to sell, and you sold. A smart trader will properly place his stop loss above here and maybe even add the number of pips based on the ATR indicator above his resistance area. And this would have been a good trade to take. But then a trader who doesn't know what he's doing will be like, you know what, I want those tight stop losses with high reward to risk ratio trades. And so immediately after entering the trade here, he might place his stop loss just somewhere around here. And that would be a foolish thing to do, because you are not even giving your trades room to breathe. And price is definitely going to move, a little bit before it moves in your direction most times. Okay, so just because you're told to place stop loss doesn't mean you should not place them logically at levels where it's going to be hard for them to be hit by random fluctuations in price action, before price starts moving in your favor. So please take note of this, okay? And this is the two common ways that traders use the ATR indicator. The first, like I told you, was for traders to use it to identify when there's an increase or decrease in volatility in the market. And the second way is for traders to use it to gauge, where to place their stop loss based on market structure, and then add the range at that particular moment in time above their stop loss level, so that they're giving their trades extra levels of protection. Does this mean that you're never going to lose trades if you use the ATR indicator? Obviously not. But it's going to really drastically help to improve your trading performance. Okay, so this pretty much brings us to the end of this week's edition of the class. But before we wrap up, as usual, I would like to use this opportunity to let you guys know about, our ITU bots, which are a suite of expert advisors and robots which are designed to help you trade while you learn how to trade manually, or, diversify a portion of your portfolio to automated trading. They will help you identify low risk, high probability trade setups automated. You don't need to do anything after setting everything up. So they will help you identify the trade setup, place the trades for you, do the proper risk management and all of that. So if you're interested in it, please reach out to us on any of our social handles or drop a comment in the comment section of this video, and we'll gladly let you know the steps you'll need to take to set up everything and get it up and running in no time. In the meantime, thank you very much for taking time out of your busy schedule, and I look forward to seeing you guys in next week's edition of the class. Have a wonderful rest of your weeks, and God bless you all. Thank you, thank you, thank you, and cheers.